And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's another Monday, getting the week underway, and unfortunately, it's still October, so we haven't even gotten to the election yet. We still have that ahead of us. Good news is, though, Halloween's just 2 weeks away. It comes, it does come on next Thursday, so it's kind of sucks. It's in the middle of the week, but 2 weeks until Thanksgiving. And then, of course, right after that, we will have the election. We'll also have the FOMC coming out with their next meeting. So lots of stuff to drive markets here over the next week or so. A couple of things, though, that we'll talk about today. In this past weekend's newsletter, we did talk about two things in particular. One is earnings, and we'll talk a little bit about earnings remain exceptionally optimistic right now, particularly going into next year. They're expecting earnings to increase another 15% next year. So that's a very, very strong increase for earnings. And that just suggests that you have to have really strong economic growth to support that. The question is whether or not the consumer can sustain that, and that's one of the big challenges right now. I mean, so far, consumers seem to be doing quite okay, right? Spending continues to do well, and again, we'll see how this goes. With the holiday shopping season coming up, we're about to start getting a lot of data about just how strong the consumer is. We're going to have Black Friday sales, which started 4 months ago. I figure at some point, Amazon's just kind of Prime Day, like every other day, right? So, exactly, just be like Prime Month. But anyway, we'll have Black Friday sales coming up as well. And then, of course, we'll have the Christmas shopping season. So we're going to get lots of data points about just how strong the retail consumer is and whether or not they can keep spending at the pace you're going, because, at 70% of GDP, it matters a lot. So, coming back to the markets, though, markets are exceptionally optimistic. And one of the things that we also noted in this past weekend's newsletter, it's on the website, is that the seasonal buy signal has been triggered, and that typically starts the seasonally strong period of the year, which lasts through May, and stocks tend to perform their best. Now, here's the issue with that, though. It doesn't mean that stocks can't have a correction along the way, and it certainly doesn't mean that every year historically always is the same. And there have been years where you had a seasonally strong period and the market corrected. As a good example, 2018. In September of 2018, remember, the Fed was hiking interest rates at the time and said, we're nowhere near the neutral rate, and the market freaked out. In November, December, the markets declined by 20%. So this is the problem with averages. And again, we've talked about this on the show before, but when people tell you, the average return of something is X or Y, that doesn't mean you're going to get that every year. That's the average. And averages can include very big drawdowns. And there is a big difference between the return of your portfolio and the average return of the markets. If I get an average return every year, my portfolio compounds, right? But if I lose 30 or 40%, getting back to even is not the same as making money. So while the rest of that magical math is just compounding every year at 8 or 9%, your portfolio is just struggling to get back to even. So this is why corrections matter a lot, and averages and what happens to your portfolio are two very different things. So just keep that in mind when people talk about averages. And again, markets are very extended. We've had the best return year for the S&P this century. We've had the number of kind of record highs is approaching a record for a given year. And markets are very extended. So historically, you have to remember one thing. We're going to talk about this in just here in a second. But records are records for a reason. Because records were where a previous run or a previous achievement ended, right? Michael Jordan, number of free throws, right? He was only able to get so many free throws, right? And so, or Usain Bolt could run at a certain speed. Now, eventually that record will be broken. But again, it's where something previously ended. In the stock market is where a previous run ended. So yes, it's like, oh, we're hitting all new records this year. That's true. The markets are hitting brand new records this year because it's hitting a level that previously marked the peak of the market. In this case, it was 2022, and you had a 20% decline. So don't forget why when we start talking about records, that records are records for a reason. Now, speaking of that, here's what you need to know before the bell this morning. So as we talked about in this past weekend's newsletter, the seasonal buy signal was triggered and typically suggests that markets will be higher over the course of the next 6 months. That's the seasonally strong period of the year. However, such does not mean that, as I said, you cannot have a correction along the way. And having a correction along the way should be expected. And there's a few things for that. First of all, the markets are now up 6 weeks in a row. Now, if we're up again this week for the 7th week, that's getting to be a fairly long stretch. But this is a weekly chart of the S&P 500 that I'm showing you this morning. So if you're driving in your car right now, don't try to look at your phone. I'll explain it to you. The markets right now have had 6 positive weeks in a row. That's a very long stretch by historical standards. We have done 7 weeks before. We have done 8 weeks before. But you're eventually going to get a week or two where the market's correct. And sometimes those corrections are a little bit deeper than others. But you're going to get a period where the market kind of slows down here a bit, simply because you just had so many people chasing equities right now heading into the election. And particularly in areas of the market that tends to favor a more positive outcome. Also, we're on a weekly buy signal. So again, that's the seasonal buy signal. But markets are very, very overbought on multiple levels. So again, expect a correction here. So again, just because the seasonal buy signal is triggered, don't go running into the markets right now to buy stuff. Wait for a little bit of a pullback. Now, pullbacks will be contained. They'll be fairly shallow, most likely. But again, the markets can have a correction between now and the end of the year that'll give you a better entry point. Markets can't just keep advancing at this same pace. It's just getting very, very extreme on multiple bases. The one thing that we continue to also notice is that you have a negative divergence in relative strength as well as momentum. So again, that's also another sign that while the market has been rallying nicely here over the last several weeks, really the last 2 months, that relative strength and momentum behind that rally is beginning to weaken, which is also kind of the precursor for a bit of a correction in the markets. Again, doesn't mean a major correction of any sort, but does suggest that some type of pullback is going to be necessary. And again, at this point, you could probably look for a pullback to either the 20-day moving average, which right now is around 57.40, or you take a look for a pullback really to about 56.30 on the S&P. So again, it could be a little bit, 3 to 4% correction could happen very quickly. Could be an event post-election, could be disappointment by the Fed, it could be some economic report, whatever it is. But something could happen that could lead to a little bit of a sell-off in the market. So don't be surprised when that happens. Again, this is why, even though we have a seasonal buy signal in place, the markets are doing well, nothing to worry about right now between now and year end. A bit of a correction will give you a better entry point. And as we noted in this past weekend's newsletter, there's 3 reasons why this market likely rallied the year. And one of that, the number one, is stock buybacks. That window opens at the end of the month. That's going to be $6 billion a day in buying. Still doesn't mean markets can't sell off a little bit, but again, a big support. So any potential sell-off will be bought between now and the end of the year. Performance of managers. There's a lot of managers behind on performance this year. They're going to have to allocate money to the markets to try to play catch up in performance. And then also sentiment is still extremely bullish here, but not super extreme. So there's still room here for retail investors that need to chase market or want to chase markets into year end to do that. So there's plenty of reasons why markets can advance. But again, just be aware that a correction somewhere is going to occur, and we'll see when that happens. But again, 6 weeks of advances, that's a very long stretch. Could be 7, but typically you're going to get a bit of a pullback. Okay, that's what you need to know before the bell this morning. When we come back from the break, we'll talk a little bit about Q3 earnings. Got some other stuff to get into this morning on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a little bit about Q3 earnings, as really this week and next week is going to be just a slew of earnings coming in from companies. We're about to hear from all the big boys. Again, we won't see NVIDIA. Of course, that's a kind of a big driver for the markets right now. We won't see them until the end of November. They report late, but over the next 2 weeks. We'll have about 85% of all S&P 500 companies will have reported earnings. So again, that's why the window for buybacks opens back up in November, because a vast majority of companies have already reported. But interestingly enough, we have some analysis. And again, this is in this weekend's newsletter. So if you haven't read the newsletter yet, which you can subscribe to, by the way, you can either get it on our Substack. Subscribe to Substack. It's free. It's all free everywhere. But you can either, if you want delivery on Substack, if you're already over there, so you can subscribe on Substack or on our website, realinvestmentadvice.com. Just click the link, enter your email address, and we'll email it to you on a Saturday. But we go through Q3 earnings this past weekend and kind of what's going on with that. And again, there's some very interesting undercurrents relative to the market, which is just seemingly very exuberant right now. Everything is going peachy keen in the stock market, as they say. I don't know who actually says that anymore, but they used to say it a lot. But right now, according to Goldman Sachs, there is a 71% chance right now that Donald Trump will win the presidency. And that's why you're seeing a lot of trades being placed on kind of the quote unquote Trump trades of that win of that election. So again, the markets are starting to predict already, and it's a bit early, which is interesting, but markets already started to place their bets for who they think is going to win the election. So while stock prices are going up, interestingly enough, and Brent, you can bring up this chart for me, the number of companies getting downgraded in terms of revisions has actually been rising. That's the chart I'm showing you. It shows the global index of earnings revisions. There's a gold line that is the number of downward revisions. That's rising sharply. The blue line, which is the number of upward revision, is declining very rapidly. So, and this is just really since the August. So in August and September and into October, the estimates for companies have just been sharply slashed. And again, this isn't surprising. What we've talked about before, this is why we always call it kind of millennial earnings season, because, everybody gets a trophy. But here's what's important about this. If you take a look, so you can say, great, okay, earnings are getting revised down, but earnings are still growing. Okay, that's true. But where are earnings growing? Well, if you take a look at the S&P 500, you break it down, only really the top 10% of companies are growing earnings. So when you take a look at the breakdown of the earnings growth for the S&P is showing earnings growth, but the earnings growth is only coming from 10% of the stocks in the index. The rest of the stocks in the index, x the top 10 and the bottom 50%, have declining earnings. So it's a very, very narrow market in terms of who's driving earnings. So if for any reason the earnings growth for those top 10 companies slow down, it's going to have a much greater outsized impact on the overall market. Now, analysts are hoping, by the way, that the rest of the market will eventually play catch up, and that for some reason the earnings growth for the top 10 companies are going to slow down and everybody else is magically going to start making earnings. But does that really make sense? If they're not growing earnings right now and only 10 companies are basically growing earnings, then what happens if the top 10 companies stop growing earnings? There's telling you that the economy is slowing down. Why would their earnings slow down and everybody else catch up? Because it's all driven by economics. It's not driven by stock traders, right? It's economics. So that argument, that logic really doesn't make a lot of sense. And again, if you take a look at the earnings growth between the Magnificent Seven stocks and the S&P 500, that gap in growth is just monstrous. All of the earnings growth has been coming from those top 10 companies, but particularly the technology companies, Microsoft, Apple, Google, Amazon, Meta, NVIDIA, have been driving that. So this huge surge in earnings is very concentrated in the market itself. And so, we've got to be aware of that. Now, again, you can't fight it right now. That's just the way it is. And you can't, make these assumptions that, oh my gosh, the market's about to crash because, this is happening. No, it just means that forward returns over the next decade may be substantially lower than what we've seen over the last 2 years, as earnings start to normalize for companies really kind of all across the board. Earnings revisions, as we said, have been negative really starting in August. There's been massive downward revisions to earnings, and so this is so companies can beat their bar. This is the largest negative revision cycle that we've seen since 2022, when we were in the middle of the Fed hiking interest rates, the economy slowing down sharply, the Russia-Ukraine invasion going on, 20% decline in the markets. You've had massive negative earnings revisions. And everybody was expecting a recession back in 2022. So it's been very, very sharp declines in these estimates. So all the prices that people were paying earlier this year based on expectations of the earnings that were projected then now they've just got really overvalued stocks because it's been so downgraded. But here's the interesting thing about this. This has been a weird cycle over the last 2 years, and this is because of all the money that's been thrown at the economy from stimulus payments and to CHIPS Act, the Inflation Reduction Act. I mean, we're just throwing money at the markets. At the same time, you had inflation, which is good for profitability, right? As long as I can pass that inflation on. Well, since I gave everybody so much money, I was able to pass on inflation. So corporate profits have been surging. In fact, U.S. non-financial, so strip out the banks, economic profits as a percentage of GDP is at a record level, and a level we've never seen previously going back to the 1950s. Now, normally profits peak in an economic cycle, as it would make sense, and you have a recession and those type of things. But again, in this cycle, because we gave so much money directly to households and then flooded the system with so much economic monetary stimulus, and then cut rates, did QE, all this other stuff, profitability for companies have absolutely exploded. Now, again, a lot of these profits are coming from a handful of companies, but nonetheless, companies are being very, very profitable. Now, this is relative to GDP, profits relative to GDP. But again, since profits are a function of the economy, that's a valid measure, right? Profits are a function of economic growth. Economic growth does not really support profitability at that range. So again, you would expect at some point that profitabilities for companies are going to start to mean revert. And especially in an economy where there's so much economic uncertainty. Again, when you look forward, there's not a lot of certainty about where economic growth is going to be 6 months from now, a year from now, 2 years from now. Still a lot of concern about potential recession. A lot of indicators still talking about, still indicating recession risk. But the economy seems to be doing fine. But on the other hand, the money that was all injected in the economy is now coming out. And economic uncertainty has now reached the highest level on record. So for businesses, their outlook for the economy is becoming much more uncertain. And so they become a little bit more conservative about hiring, about spending, CapEx, etc. And when they start cutting back on hiring, reducing CapEx expenditures, those types of things, then that's going to lead to slower economic activity because those are part and parcel of economic growth. Now, here's the important thing about this. Wall Street, though, remains exceptionally optimistic about earnings. Despite all of this, right? Economic uncertainty, etc. Wall Street is extremely optimistic. For the fourth quarter of 2024, they are expecting a 12% growth in earnings. Now, they're only expecting 4% this quarter, a 4% growth rate in this quarter for quarter 3. Earnings are only expected to grow by 4%. That's going to go from 4 to 12 in the fourth quarter. In the first quarter of 25, it's going to grow by 14%, 13% in quarter 2 of next year, 17% in quarter 3, and 15% in quarter 4 of next year. So the growth rate for the S&P 500 is expected to explode next year amidst a backdrop of economic uncertainty. Now, that really doesn't make a lot of sense, but it's very optimistic. Stocks are priced on optimism and forward earnings expectations. But importantly, analysts, and we'll talk about this after the break, let's go take a look at just how accurate analysts are about their earnings. And as investors, how much weight can we put into those expectations that they're throwing out there? Talk about that after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
And I've told you before about my dogs. They're 28 pounds. So I've got one that's half German Shorthair Pointer, half Terrier. The other is half Terrier, half Ashani.
The Real Investment Show podcast.
Little brown one. He is solid muscle. I mean, when he just sits still, his muscles are flexing and rippling right through his body. He's very muscular as a dog. Surprising me how strong that little dog is. So I now have new motivation at the gym.
Yeah. Same show, your schedule at realinvestmentadvice.com.
When I go to the gym, I have a picture of that dog because I want to look like him.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So talking a little bit about earnings expectations. They're wildly optimistic going into next year. And again, this is important to understand because stock prices track earnings growth. Real earnings growth, not expected earnings growth. But forward earnings right now are very optimistic. And right now, forward PE valuations are very overvalued. We're running 21 times forward PE right now, so very expensive. But the question is you say, okay, great. If earnings are going to be 13% next year on average, I'm going to buy stocks today because if earnings grow by 13% next year, then the price I pay today is going to be fairly cheap relative to where earnings will be next year. That makes complete sense. But you have to expect that expectation for earnings growth will come to fruition next year. Because if it doesn't, then you just wound up overpaying for an asset. Think about it this way. You go to a dealership and you're going to buy a brand new Yugo. Is that the best you can do? No, I have a reason for a Yugo. Okay. Does anybody remember what a Yugo is, by the way, in chat? Yeah, you do? Yeah, Brent does. I don't. This was a Yugoslavian car. It was built, and it basically it was 2 doors, and it had a rubber band for an engine, and it came with a cassette tape that you would put in to the cassette player, and it go vroom, so that it actually made engine noises. But no, it was. But you're going to go to the dealership and you're going to buy this Yugo, right? And the dealer says, you want to buy this car. Don't worry about buying that 1962 Barracuda sitting over there that, is currently worth about $180,000. Don't worry about that one. Buy this Yugo because next year, everybody's going to want one. They're coming back into style. Trust me, they're not. And so you say, okay, great, I'll buy it. So you pay $5,000 for this Yugo, and next year everybody's supposed to want this thing. So you're expecting the value of that Yugo to go up in price. But if nobody wants it next year, and trust me, they won't, the value will not go up, right? And it's the same thing for the market. Expectations are what drive market returns in the short term. Everybody's buying stocks because the analysts are telling them that, earnings are going to be a lot higher next year. Well, let's take a look back at history at analyst estimates for earnings and see if we can predict a pattern to what earnings will be for next year. So going back to 1994, this is the earnings that actually came to fruition, so trailing earnings, versus where the estimates started and where they ended. Now, they ended at where earnings were reported, right? So these squiggles in this chart, it looks like a bunch of worms, right? But you'll notice that in virtually every single case, earnings started substantially higher than where they wound up. In fact, if you go back and you measure this, it's about a 30% decline. So in other words, the analyst said earnings are going to be $1. They came in at 70 cents on a fairly consistent basis. So you can't really put a lot of weight on what analysts say. But if analysts are always wrong, now wouldn't you expect that if analysts are always wrong, that they would stop overestimating? Well, remember, their job is to sell you a product. And if I tell you that earnings aren't going to be great next year for a company, then why would I, how can I sell you the stock in the company? Because remember, that's Wall Street's job, is to sell you product. The Wall Street Journal ran a survey of Wall Street analysts a few years back. And I wrote a whole article about this called The Truth About Wall Street Analysis. And they went through and they said, who's your most important client, right? Retail was at the very bottom of the list. One of the questions they asked him is how important are the following things to your compensation? So in other words, as an analyst, how you get paid and what factors into your bonuses, your salaries, all those type of things. What are the most important factors? Well, industry knowledge was number one, obviously. Your standing in analyst rankings was number two. How did they rank among other analysts was number two. Their professional integrity, accessibility or responsiveness. So when somebody wanted to ask them a question, were they around? Your relationship with management of the companies that you follow, because obviously you need data directly from the CEOs, CFOs of these companies, so your relationships are very important. Your success in generating underwriting business or trading commissions. Your written reports, things that you put out there telling people about how great things are. The profitability of your stock recommendations and the accuracy and timeliness of your earnings forecast were at the very bottom of the list. They are the least important to the analyst recommendations or their analyst compensation. So if those things aren't important, then why do they care about how accurate they are? Right? If I just tell you, earnings are going to be great, and then my job is to sell you product, of course I'm going to tell you things are great. That Yugo is going to be worth $10,000 next year. You should buy it today at $5,000. And it comes with 2 cassette tapes. Right? So, that's the whole point. So you've got to remember this as investors and as you go through the markets. And as you invest and as you understand this, is understand what side of the trade that you're on. This is why they call Wall Street the sell side. You're the buy side of the trade. As a retail investor, you're the buy side. Wall Street is the sell side. They sell you product. They sell you expectations. they're the ones telling you, oh, you need to buy this because it's just going to go up in price forever and ever and ever. Amen. Right? That's their job. That's how they make money. It's not necessarily how you make money. In fact, this is why retail investors, on average, vastly underperform the markets. Take a look at the bank revenues from just this latest earnings season reports, just last Friday, JP Morgan, Bank of America, Wells Fargo. Most of their income came from trading revenue. They did fantastic in terms of creating millions and millions of dollars of profitability in trading activity. How did they do that? In order to trade something, I have to have a willing buyer. Who do you think Wall Street was selling to you? Do you think they were selling them to other professionals that were also trying to sell product to somebody else? Do you think they were all just swapping between themselves? Or do you think they were selling them to their clients, their retail investors? So if you're a client of JP Morgan and they're making recommendations to you about what you need to buy, you should be asking yourself, well, what are they trying to offload? Right? What are they trying to get off their books? Hedge funds were selling stocks like crazy, back in June and July before the yen carry trade blow up. Retail investors were buying them hand over fist. So again, as is always the case as an investor, whenever somebody approaches you and says, hey, you should buy this, ask yourself, why are you telling me? Why am I so lucky to get this bit of information? And this is why technicals are so very important into managing your money and understanding when things are egregiously expensive and things are extremely overbought. It's as we've talked about before. Understanding the very basics of how price analysis works can save you a ton of heartache over time. Doesn't mean that when things are extremely extended or extremely overbought that they're going to correct today, tomorrow, this month, next month, maybe even next quarter, but they're going to eventually correct. We've talked about, stock prices. And if we take a look at, for instance, stock prices on a monthly basis, we're extremely overbought. You're going to have, every time that stock prices have been this overbought on a monthly basis, relative strength-wise, momentum-wise, etc., you have always had, historically, a correction of magnitude. Doesn't mean it happened today. So just because it's overbought today, as it is, doesn't mean that it's going to have a big correction. It could be this month, next quarter, next year, could be the year after. There are periods where the market's 1997, 1998, 1999, 3 years the market was overbought and still rising, and then it quit. Same thing occurs right now. A lot of people wanting to, I just saw an article out this morning from Wall Street talking about gold. Gold is more overbought now than at just about any other point in history on a monthly basis. It's almost 5 standard deviations above its long-term monthly average. Its correlation to stocks is 1. And on a relative strength momentum basis, extremely overbought. Can stay that way for a while. But buying it today is not likely going to work out well for you. That's just what the technicals tell you. Again, whether or not you agree with it is irrelevant. Wall Street's trying to sell it to you. Wall Street's trying to sell you stocks. Wall Street's selling everything right now. This is an everything market. Everything is going up. So no matter what you own, you look like a genius right now. But that's when you need to ask yourself the question, what do I need to do next? All right, quick break. Come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So this morning, futures are down a little bit. Not surprising, though. We've had 6 really good weeks in a row. Markets have just continued to be kind of on fire here lately. But again, don't be surprised here that to see this market relax. Again, when you go through all the data, there's nothing wrong with the markets right now. There's no reason to be overly bearish. There's no reason to be overly concerned. The trends are positive. You've got a lot of functional tailwinds behind the markets right now. So again, this is not the point to where you want to be overly conservative with your investing. However, again, this is an everything market right now. We've seen these before. We had an everything market in 2019 going into early 2020. Didn't work out so well. We had an everything market in 2021. Didn't work out so well. There are periods where everything goes up at once because everybody's just buying everything they can get their hand. And again, no matter what your thesis is, it's all working. So there's no reason not to buy it, right? Because if I buy it, it goes up and you pat yourself on the back. Say, see how smart it was? I bought this and it went up in price. Lately, we've been trying to buy stuff that's out of favor, right? And that's the harder challenge, is trying to buy stuff that people don't want. And we're trying to position ourselves for what we expect to be kind of that year-end, push in the markets. But again, we're holding a little bit of extra cash right now. There's some opportunities that we think will come up when we get a correction. And I do think we'll get a correction here in the next, few weeks, maybe a month. We'll see. I mean, it could be kind of buy the rumor, sell the news. As I said earlier, Goldman Sachs today put out a research report over the weekend. Let me see if I can find this one real quick because, here it is. JP Morgan had some commentary out this morning. This was in their positioning intelligence report. All in on Trump, how positioning is shifting ahead of the U.S. election. And this is from I'm just reading from JP Morgan. It's not my work, JP Morgan. So don't yell at me, just the messenger. As odds of a Trump presidency and red wave have increased over the past few weeks, we've seen themes that are perceived to be Republican winners. And they have baskets. Goldman Sachs, JP Morgan, they have baskets that they put together. And if you have a Bloomberg terminal, you can look at these baskets. But they have these baskets of what they perceive to be Republican winners: energy, infrastructure, technology. Right, those ones, finance, because of deregulation. So those are in the Trump basket. In the Harris basket, it's green energy and those types of stocks that fit with her policies. So having said that, back to the report, we've seen themes that are perceived to be Republican winners outperform Democratic winners by more than 7% over the past month. Crypto stocks, small caps have performed better. Renewables have underperformed. This is the baskets. In addition, the wider U.S. equity market continues to make new all-time highs, and positioning appears to be elevated. Based on thematic shifts, historical returns around elections, and elevated positioning, here's the key line: there's a bit of room for disappointment and reversal in the coming weeks if odds start to shift in the other direction. That's the key line. The markets are, as I said, markets are way overextended. We've had 6 weeks of return. If we get closer to the election and all of a sudden the odds or the polls really starting to tighten up, or if there's a massive wave of mail-in balloting, et cetera, in swing states, et cetera, that could start to shift the odds of the outcome back in the other direction. That would likely disappoint those trades that have been really outperforming in the market as of late and really keeping the market elevated. This has not been a super broad rally. It's been good, right? But if we see a shift, we could see the market go through a corrective cycle as markets try to de-risk right before the election. So there's still that pre-election risk of a sell-off in the markets before the actual November 5th election. And again, with markets very elevated, it wouldn't be surprising at all. After that, after the election's done, and then of course we also have to make the assumption that the election is not contested heavily. That's another risk going into the end of the year. But after November the 5th, buybacks are going to be kicking in hard and heavy. So if you get a correction, that's going to give you a better opportunity to put some capital to work selectively in the markets. It's not going to be just to buy everything. If you don't really know how to, build a portfolio, then just buy an index fund, which will get you, kind of whatever the index does through a year. And there's nothing wrong with that, by the way. If you just need exposure, but you don't know what to buy, just buy an index. Selective exposure will outperform the index, but that's a much harder challenge if you get it wrong. So just sometimes just, and we do this even in our portfolio. There's times where we have a fully allocated portfolio more or less, and we see an opportunity to add capital to the portfolio, but we're just not, we don't want to really overweight some sector, or there's other sectors that have been lagging that we don't want to add a lot of money to. We'll just stick in an index ETF just to get the exposure up without having to worry about positioning as much. So sometimes, index ETFs are a great tool to use. So don't ignore them, even if you're an individual stock picker. But continuing on with JP Morgan, in other words, what JP Morgan is saying is that the stock market is basically building building a win-in for a Trump presidency. That's where the market is pricing itself right now. Now, again, that's just the market. Can the market be wrong? Yeah, they can be wrong. The market has a pretty good track record of predicting elections historically, but it has been wrong. So again, you can't take anything with an absolute certainty. There are certain indicators that we can look at. There's certain things that we can view and say, okay, and again, the market is a big hive of intelligence, right? These are analysts and computers and experienced professionals and traders from all over the world that are in the market, right? And so you got all these thousands of minds, millions of minds, all out there analyzing the same sets of data and coming up to a similar conclusion. That's a pretty good analysis, right? Versus just you or me, just me looking at a set of data and saying this is what we're going to do. And this is why, going back to technical analysis, this is why it's so helpful to apply to your investing process, because all that technical, again, just basic technical analysis, you don't have to get all fancy with it, right? You don't have to go all the extreme and do all the crazy stuff. Just some very basic analysis, relative strength index, a MACD, couple moving averages. That's all you really need. And you don't need a bunch of fancy. We have a lot of proprietary settings that we've developed over the last 35 years of managing money that we use. You don't need to do that. We just have some things that we like, that we work with, right? And we understand. You don't have to do that. You just use the basic settings. Relative strength index, 14 days, right? Just moving average indicator, MACD, 12, 26, and 9. 12 days, 26 days, 9-day signal. Those are all just the basic settings that come out of any out-of-the-box software. But it'll help you because you don't have to worry so much about what the indicator is telling you, other than it's a representation of what the markets are all thinking at one time. And so when everybody's on one side of the trade, if everybody's standing on one side of the boat, right, the boat's going to start kind of listing to that side. And then eventually at some point, some trader somewhere is going to go, you know what, I'm out. And then when they say they're out, a whole bunch of other people get out at the same time. And it kind of starts to run to the other side of the ship, and the ship shifts in the other direction. And that's why you have corrections in markets. If it didn't happen that way, markets would just be a flat line. They wouldn't go up or down. And so, this is why it's always important. People always say, oh, well, for every buyer, there has to be a seller. That's true, right? But if everybody bought and sold at the same price, the markets would be flat. They would not go anywhere. Just you'd look at the stock market and be flat line. So yes, there's always a buyer for every seller. The dependency is at what price. And so if everybody's on one side of the boat, all buying at higher prices, prices go up. At some point, there's a buyer that says, I don't want to buy here anymore. And that's when the sellers all come into the market and going, okay, but what price would you pay for it? Lower. And markets decline very rapidly as buyers exit, and sellers have to keep dropping prices to try to find a buyer. So what technicals tell you, and again, just very simple analysis. And again, I promised you a week or so ago that I'll spend a day here on the show, and we'll just go through some basic technical analysis. Maybe we'll do that on Thursday with Mike or something. We'll just go through some basic technicals so you can kind of get a feel for it. But just applying a little bit of that analysis to your overall thinking, and no matter what your thesis is, I don't care. Theses are great. But the technicals will tell you when everybody else is thinking just like you. And that's when you need to start thinking about taking profits. All right, wraps up the show for today. Be sure and smash that like button for us. We certainly appreciate it. Get by the website. The latest article on Q3 earnings is on the website. The newsletter from this past weekend, it's up now. realinvestmentadvice.com. Also, don't forget, follow me up on Substack. We appreciate it. We're growing a nice little following over there. We'd love to have you join us there as well at Substack at Lance Roberts. We'll see you there. Anything we do to help you, realinvestmentadvice.com. And we'll see you back here tomorrow with John Penn.